What's up, everybody, and welcome into today's video. If you're new to the channel, we are the cream that stands for cash flow, real estate, and money. My name is Dave Payerchin. I have my main man, RJ Pepino, by my side, and we're full-time real estate investors. So we own and manage a portfolio valued over $50 million, and we built this thing brick by brick, door by door, property by property. We are experts at raising private money, and we're still doing deals right now. We're buying rentals. And we also have a robust flipping business that brings in over six figures every single month. We are grateful that you're here, grateful for you, and we're happy to help you in any way we possibly can on your real estate investing journey. Make sure you subscribe to the channel if you're passionate about real estate investing, just like we are. And today, we have a very unique video because I'm going to be exposing data, exposing some statistics regarding evictions, which are surging in many parts of the country, including our own market, where we operate the majority of our properties in the Columbus, Ohio market, the central Ohio market. So we're going to talk about this data. We're going to talk about why evictions are surging in certain areas and not surging in other areas. But most importantly, stick around to the end of the video, because that's where we're going to talk about how do we maximize this opportunity. All things are an opportunity if you know how to look at it the right way. And us as real estate investors, we're going to be talking about and getting RJ's feedback on what he sees the biggest opportunity is right now and how we can maximize and do more deals. RJ, you ready to check out some of this data that I put together?
Yeah, I think I may have saw it yesterday as well, but I'm interested in seeing what else we got here because it's crazy how evictions are up in certain areas. I'm not surprised. I'm not surprised with what's going on in the market right now. You know, the economics in some of these areas, I'm just not surprised. It's like, when one aspect of the economy is hurting, it kind of spreads out and affects renters. So what do we got today here?
Yeah, as a
Evictions
matter of
rise.
fact, and I don't talk about this, today is July 18th, 2024. Jobs data came out today, and I'm not citing that particular data in this video, but for reference, jobs data came out today and it came in high, or jobless claims, I should say. So there's jobless claims are on the rise, everybody. The economy is starting to soften, and I think we're also seeing that, as causing these evictions to be on the rise. But right here, I am citing the Wall Street Journal, and they say eviction filings over the past year in a half a dozen cities and surrounding metropolitan areas are up 35% or more compared with pre-2020 norms. So that's pre-pandemic, right?
Mhm.
According to the Eviction Lab, a research unit at Princeton University. So they're seeing six cities, half a dozen cities, and the surrounding metro areas. We're going to be looking at these cities, and basically evictions are up 35% in comparison to pre-pandemic. So these cities include Vegas, Houston, Phoenix, where landlords filed more than 8,000 eviction notices in January. It's not just the Sun Belt. It's not just these warm cities. We're seeing cities that had the biggest run up are seeing the most softness now. So what caused the run up of rent? What made rents explode is just the sheer demand. So during the pandemic, a lot of people wanted to be in homes. They wanted to be in single family homes. It was a work from home type of environment. So everybody was rushing and racing to rent a home or buy. Everybody was rushing and rent to buy a home too. Interest rates were insanely low, and that was causing the home prices to go through the roof. But everybody wanted to be in their own environment, work from home, and that caused the rent rates to go through the roof. So check this out. We got Vegas. We got our own Columbus, Ohio, made it. Unfortunately, we're seeing a lot of eviction filings. So the black line that you see here, RJ, this is the pre-COVID average. And you see places like Vegas, Columbus, and Phoenix were much higher than the pre-COVID average. And then you see places like Dallas that's holding up pretty good. But look at New York, look at Philadelphia. And the reason places like New York and Philadelphia, and you talk about this quite a bit, RJ, is this is the difference between like a red city or a red market versus
Hmm.
a blue market. And we're not making political posts or content here. We're just talking about the legislation in certain marketplaces and certain MSAs is certainly different than others. So a place like New York City or a place like Philadelphia, what you have is a very tenant friendly environment. In
Yeah.
fact, I spoke to another investor today who's operating out of the Philadelphia market, and they said it takes 6 to 12 months to complete an eviction in a place because it is very tenant friendly. Therefore, landlords in places like Philadelphia and New York City are far more inclined to do a tenant workout and work something out with the tenant if they can't pay rather than filing evictions. Therefore, you don't see the drastic increase. You don't see the number of eviction filings because the landlords are far more eager to just do a workout program. They don't want to have to file eviction because they're not going to see a penny for 6 to 12 months in these places. Now, you go to places like Vegas, you go to places like Columbus, and you go to places like Phoenix, it's more landlord friendly. Therefore, the landlord is more inclined to just file eviction, get the person out, because it's easier to get them out. They would rather get them out and get somebody else in there who can pay rather than doing a workout program. Another thing that is affecting the increase in evictions is the rental assistance programs are drying up in
It's
pretty
yeah.
much nationwide. We used to take advantage of these rental assistance programs. RJ and I, during the pandemic time, we were eagerly helping our residents who needed the assistance get the assistance they need so they
Mm.
can continue and avoid eviction. This is an interesting thing here, RJ. Eviction related fundraisers on
Oh,
GoFundMe are up 40% from
mm,
pre-pandemic levels. So people who are running into trouble with their rent are looking to raise money from friends, family, and whatnot to pay for their rent so they
yeah.
don't get an eviction on their record. But that is pretty much what is going on. Now I want to turn it over to you, Mr. Pepino. What do we do as real estate investors? How do we capitalize, monetize, and maximize in today's current times?
Go back to that slide to um right there, that one with the graphs. So here's where some people are would look at this, or some investors maybe new, maybe have one way to look at this. But if you look at where New York and Philadelphia is, one way to look at it is like, I will never invest in those states. Yeah, because it's harder, right? It's harder to manage and do what you want with the residents. But our mentality is, everybody, our mentality is work it out with the resident.
Yep.
Let's work it out. It doesn't help them, right? It doesn't help them to just we kick them out and oh yeah, we're gonna get another person in there. That's not what we want to do. As somebody that's owned over 200 rentals, Dave and I do not take this stance. We want to work it out. We're gonna pick up the phone and say, hey, what's going on? Have you tried any of the rental assistance programs before? And we keep them all in the database. So we want to work with our residents. And this was we did this pre-COVID. So when COVID happened, we're always in the stance of like, let's work it out because yeah, our landlord laws are pro the landlord, but it doesn't do the landlord any good when the resident is not there. It costs us money. It costs us a turn. It'll cost you someone that's upset, and then they're going to then destroy your rental. And then your cost of maybe recouping some of that rental income for 2 or 3 months is like you got to wait for 2 years to get recoup that because a turn anymore isn't how it was back in 2009, 10, and 11. A turn cost is closer to $10,000 to $15,000. When you own single family homes, you have a bigger unit. You not only have the inside of the unit, you got the exterior, you got the windows, maybe you got a garage. You got to consider the whole thing. Now, even if with apartments, they can still break windows. They can still mess up stuff like, your plumbing. That costs a lot anymore. So this is a clue. Look, New York City and Philadelphia, because they have landlord-friendly laws and it's a little harder to evict a residence, you got to work programs, payment programs. We do that too. So if you look at it a little bit differently, my advice is to definitely work with your residents, keep them in there. Rental assistance is, drying up, but there's going to be more rental assistance programs. So stay in front of that. And how do you do that? You want to join your landlord property management type groups, right? You want to go into, sometimes they're local municipality, programs that they'll host in libraries or in anything in the county, at the county level. You want to make sure you stay in front of the laws and what's going on and just be in front of it. You can always just go rental assistance programs, just Google that in your city, county, and you're going to be able to see that. That's our stance. We want these residents in. Yes, evictions are up. Okay, great. It poses some opportunity. Maybe some landlords are just maybe done, and then you can ask them to sell the unit to you, right? That's an opportunity for y'all. But that's our stance. It sucks to see the people that are going through evictions. But what they don't know in landlord-friendly states like Columbus, in order for them to even get assistance, they have to be in the process of eviction. So it's not like, oh, Ohio, they're just throwing people out. No, sometimes it's part of the process to get them on a payment assistance program. So I think, at the end of the day, our stance, let's keep them in there. Let's keep that revenue in there and not kick them out in the streets. Work it out with them.
I mean, the construction costs are through the roof, right? And to
Right.
turn a unit, RJ and I, we want to keep these people in our properties. It's very expensive. It'll eat up all positive cash flow. I mean, the average positive cash flow on a unit, what, 300-400 bucks a month? What is that, 4,800 bucks a year? I mean, the average turn cost is higher than 5K a year. So you're losing money by having a high turnover rate. It is always better to do a workout plan with a resident who is willing and able to do some type of payment plan than have to take the unit back and then get it all cleaned up again. You're going to be losing money. So everybody, make sure you leave us in the comments below. Let us know what you're seeing in your market. Always remember, the real estate market is a local business, right? So wherever you are operating, wherever you are investing, it's going to be different than maybe some of the markets we're talking about in this video and different than where we invest. So let us know in the comments what you are seeing. And we're still buying. So don't be afraid. Obviously, don't be on the sidelines. We're still acquiring rental properties, very bullish on the affordable housing market, which we talk about in our videos ad nauseum. And we're happy to help you on your journey as well. Go to creamlaunch.com, click the blue button, set up a call with RJ, myself, or somebody on our team, and we'll tell you about our coaching program. Our coaching students are doing very well, acquiring rental properties and then flipping everything that doesn't make sense for a rental property. That's pretty much the real estate business as a whole. So make sure you like the video if you found it valuable. Make sure you subscribe for more real estate videos, and we will see you all on the next video.
Peace. Like